Through the second half of November, we've seen wheat prices easing a little to sit some $4 to $5 a tonne below the peak prices seen in mid-November. And that comes despite quite a sharp rally in US futures after the US Thanksgiving holiday and a decline in the Australian dollar as well. The decline in prices has been triggered primarily by a sharp drop in basis levels. So across all port zones, basis levels are down around $39 a tonne from the peak levels seen mid-November. Basis has been easing as the Australian market struggles to keep up with the rally in US futures, but also driven by an increase in farmer selling as slightly more attractive prices became available for growers to sell off the header, and also easing against forecast rains and rain starting to fall during the first week of December in the summer cropping areas in New South Wales. If that starts to secure a summer crop, it will certainly ease the supply issues surrounding feed grains in the East Coast market. So we have seen that easing in prices, and with the drivers of the US futures market being primarily speculative against potential winter kill issues in Russia, unless there is new information coming forward to drive that market higher, we are likely to see the market pull back after the sharp rally that we have seen. If that market comes back and Australian basis levels don't improve, then we will tend to see those lower prices transferring into the Australian market. So where we sit right now, it does appear that the market is in a softening trend, and depending on what impetus we get from offshore as to whether that trend continues sideways or down a little. The factor driving the Australian dollar has primarily been a sharp decline in crude oil prices, which has rippled across all energy prices. That has also had an impact on the global oilseed markets and corn markets, where biofuel prices are also being hit by the lower crude oil prices. Canola prices have tended to drift down a little over the last 3 or 4 weeks into this early part of December, and that is primarily on the back of lower crude oil prices, harvest for the oilseeds finishing up in the US and peak harvest pressure having hit the market. And we are also seeing a decline in import purchases by China. They made significant purchases in early November. Those purchases are now arriving in China, and against that large influx of supply, they haven't put new orders into the marketplace. It's really hard to see where upside for canola might come from over the near term, and so a sideways to gently downward trend is probably the most likely outcome for the rest of December into the Christmas holiday period. Barley prices have done a little better than the other grains, and in the key export regions in South Australia and Western Australia, feed barley prices are currently at their highs for the harvest. Hard to see how prices can go higher if wheat in particular tends to trend sideways, but it has certainly given a good selling opportunity for barley growers across southern Australia. Malt barley premiums seem to have peaked and come off a little, but malt barley prices are being supported by the high feed barley prices at this stage. As we progress through December and into January, we would expect malt barley prices to tend to trade sideways to slightly down, particularly if feed barley prices can't hold at their current harvest highs.